You'll believe me when I say it gives me no pleasure to say that we're deeply in trouble.
Nearly half a century ago, in 1976, Britain faced humiliation on the world stage. Then Chancellor Denis Healey was forced to go cap in hand to the International Monetary Fund, begging for a bailout to rescue a collapsing pound and a government drowning in debt. This week, whispers of that nightmare resurfaced. Serious economists are warning that Britain may once again be on the edge of a sovereign debt crisis, a crisis that could eclipse the turmoil of the 1970s and force the nation into unprecedented financial submission. Front pages screamed with alarm. UK government borrowing costs have soared to their highest level in more than 25 years. Bond yields, the interest rates Britain must pay to borrow money, are spiraling out of control. The grim arithmetic is stark. When bond yields were last this high, Britain's debt was 36% of GDP. Today, it stands at 100% of GDP. The government now spends twice as much on debt interest as it does on education. It is a slow-motion car crash happening in real time, and most of the public barely realizes it. The markets have delivered their verdict. They don't trust the Bank of England's insistence that inflation is under control. They don't trust Rachel Reeves and the Labour government when they claim spending is sustainable. What they see instead is chaos. Borrowing ballooned in last year's so-called Halloween budget. Spending exploded again in April, and another round of fiscal fireworks looms this autumn. Financial markets, the lifeblood of Britain's economy, are beginning to recoil. Sovereign wealth funds, global insurers, and investment houses are now demanding punishingly high returns before lending to the UK. The result? Britain's long-term borrowing costs are now higher than those of Greece, Spain, and Italy, nations once derided for their lack of fiscal discipline. And let us not forget, when Liz Truss's mini-budget triggered turmoil in 2022, borrowing costs spiked, but even then they were lower than they are today. This is not just a warning shot, it is a deafening siren. Behind the cold numbers are real lives being squeezed. Families already struggling with the cost of living crisis now face soaring mortgage rates as government bond yields ripple through the housing market. Parents watch school budgets shrink while billions are siphoned away to service debt interest. Young people told to dream big see the future closing in as job markets tighten and inflation eats into wages. Ordinary citizens are paying the price for political short-termism and fiscal recklessness. The shadow of 1976 looms large. Back then, Britain's currency collapsed. Sterling plummeted from $2.60 to $1.60 against the dollar. Confidence evaporated, and humiliation followed as the IMF dictated terms to a weakened nation. The eerie parallel: Britain is once again borrowing beyond its means, testing the patience of global markets. Only this time, the stakes are even higher because the scale of debt is far larger and the room for maneuver far smaller. Economists across the spectrum are sounding the alarm. Cambridge professor Jagjit Chadha has likened today's crisis to a 1976-style meltdown. Former members of the Monetary Policy Committee echo his fears, insisting markets are calling time on British fiscal illusions. Private messages among city economists are filled with one chilling refrain: "This is unsustainable." Nigel Farage summed it up bluntly: "We are now paying more on debt interest than we spend on schools, twice as much, and unless something changes, we could soon be forced back to the IMF." So, what lies ahead for Britain? Two paths emerge: the path of collapse, Continued reckless borrowing. Markets lose all faith. Sterling plunges. Britain is forced into international bailout negotiations, surrendering its economic sovereignty. The path of hard choices. A government finally admits reality. Harsh spending cuts and painful tax hikes are introduced. The political backlash is severe, but fiscal credibility is restored. Barely. Neither path is comfortable. Both demand sacrifice. But one path leads to survival, the other to ruin. At its core, this is not just about spreadsheets or bond markets. It's about whether Britain can remain a serious nation, one capable of governing itself responsibly without collapsing under the weight of its own debts. It's about whether today's politicians will have the courage to make unpopular decisions or whether they will kick the can farther down the road, leaving ordinary citizens and the next generation to pay the price. The warning signs are flashing red. Economists compare it to 1976. Markets are demanding action. The British people are already feeling the pain. But here is the question. Will the Labour government wake up before it is too late? Or are we sleepwalking into a new humiliation? A repeat of the IMF years, this time with even higher stakes. What do you think? Are Britain truly on the edge of another 1976-style crisis? Or can decisive leadership still pull us back from the brink?